Let me turn to what I think goes on in the heads of professional investors. Now, everybody is different, and so you are not going to find everybody who fits exactly this cookie cutter. But I think that there are trends here which are important to understand. First, they tend to focus on market segment trends and figure out in what areas are they going to invest, and then on specific startups. They may, in fact, study an area for quite some time, for months or a year, to really become experts on what's going on in that market segment, because they believe that the segment is important. And then they go shop for the best startups in that area, that the ones who have the best understanding of it, or have the best technology, or the best reputations, or something. And the focus on market segments sometimes is not very original. There is very tight networking among VCs. They all read, the same Wall Street Journal. They all go to some of the same hot conferences. And so they often will pursue the same market segments at the same time. And it creates the impression, at least, of a herd instinct. That's good and that's bad. It's good in the sense that you can look at where the VCs are going and know that that's going to be an area where there's probably more than one VC who would be interested in your hot startup in that area. And it's bad in the sense that it can be more difficult to be really original. You may be able to identify a market segment trend that the VCs haven't caught on to, and they may go, huh? Why? Why are you doing that? That's not interesting. That's not part of our investment thesis. And it can be a little bit more work if you're too novel, too original along the way. I think that VCs also have a bipolar sort of sentiment. And VCs love hot startups. They love the idea that they're dealing with teams that are as sophisticated, as innovative as they are, where they can really turn on the charm, where they can show their best stuff, and they don't mind competing with other VCs to get your attention. And so it tends to create this situation that when you're hot, the VCs are all over you. If you get, and partly you play this. If you get one VC interested in what you're doing, you may go call on other VCs and say overtly, or at least hint, or they may hear for themselves that you're talking with other VCs, and that immediately makes you more attractive, because the VCs assume that other VCs are doing a pretty good job of vetting you, of establishing that you've got the magic stuff. And suddenly you're more attractive. So when one VC gets interested in you, other VCs may get interested in you as well. And it can create this wonderful courtship environment. And when you're in this zone, you want to move fast to leverage it. You don't want to be too coy. You don't want to stretch it out. You don't want to be in discussions for too long. You want to find your best partner relatively quickly to leverage the fact that you're hot. When you're not hot, when you're in a segment which is not in fashion at the moment, or if you don't have a prior reputation that you're banking on, it can take heavy lifting to get VC attention. And you may need to shift the story. You may even need to be shifting the fundamental strategy to get into a space where the VCs will start paying attention. And it takes quite a bit of patience. And that's why you have to stay lean until you really see objective evidence that you have some traction, some some traction in terms of technological progress, and especially traction in terms of customer attention. There's a really interesting gap in risk tolerance. It's critically important to understand that VCs are working to maximize the value of a portfolio, and they will have a lot of companies in their portfolio. And there is a wide distribution of outcomes for any given startup in their portfolio. They have a portfolio in part because they can't tell, even with all their research and conversation, they can't tell which of the companies are going to be the most successful. But it's all built the way that the whole startup world works, such that one home run, one really successful company can have huge returns, and that you can see that, you know, the early investors in an Uber or a Facebook or Anthropic have gotten huge returns because they may have put tens of millions of dollars into it, but they've gotten tens of billions of dollars out of it. And so one home run pays for a lot of failures, which is why they have a portfolio, and why they start paying more and more attention to the companies in their portfolio which are showing signs of breakout success. Founders, on the other hand, may not be quite as committed to, you know, making $100 billion, making $10 billion instead of $1 billion. VCs are looking for return on their biggest success because the distribution is so wide. Founders, on the other hand, care about just one. They want to make sure that their effort is successful. They may not take as many risks as the VC would have them take. So, because founders say, you know, if I have a 5% chance of making the company worth $100 billion if I go down this path, or I have a 50% chance of making it worth $20 billion if I go down this path, might consistently choose the latter, whereas the VC would choose the former. The small chance of the huge success is disproportionately important to the VC, whereas for the founder, I think founders, when they're thinking in financial terms at least, are thinking about what is going to make a lifestyle change for me if it's successful. And that doesn't require $100 billion, hopefully. So that's point number two. And being aware of this difference in risk tolerance, the VCs are willing to take more risks for your startup than you may be willing to take, is worth keeping in mind. Once you get into negotiation, time is on the VC's side. They can typically afford to wait until your need for money fits their deal proposition. So you will sometimes run into investors who say, oh, you think it's worth X, and I think it's worth X over 2. And you say, well, I'm not going to take your deal. And they say, fine, see you in 6 weeks. When you realize that nobody is stepping up to your imagined valuation. And if you are starting to get close to needing cash, you may be much more willing to negotiate. Now, I'm grossly oversimplifying the delicate dance that takes place because it's not just about arguing about a price, but there certainly is the case that the VCs aren't running out of money. The only thing that creates urgency for them is the idea that you might take somebody else's money. And so they are trying to make a judgment on what is the likelihood that you will find a good offer from somebody else in a relatively short time window. And therefore, when you're in that situation, you need to do some combination of deciding to act quickly and continuing to create compelling events, things that help the VC get to a place where their fear of missing out is greater than their eagerness to do a deal at the best possible valuation for them. And finally, I think it's really important to recognize the brand stature of venture capital firms, especially the bigger name firms. This is Andreessen Horowitz or Sequoia. I think Lightspeed fits into that category. NEA, Mayfield. There's a long list of tier ones that if you're in the portfolio of one of these companies, you have been marked for everyone in the know as someone that is likely to be a winner. So just the act of being anointed as a success by a big name VC firm is worth significant amount of money. Plus, they employ really, really smart people. And those people have lots of good ideas and lots of contacts and lots of ways to help you. So if you can get there, that's great. Of course, the big name VC firms provide only a modest fraction of all of the venture funding that takes place. And so you may need to go with a lesser name because that's the best you can do. And then play up and use the resources that they do have to the best of your ability. But there is a real hierarchy there. So let me talk a little bit more about what it means to work with investors. What's really going on there? There's the question of when do you raise money and how much? As much as possible, you want to raise money before you need it. If you're up against a cash crisis, it creates a terrible negotiating context. You're taking really significant risks. And taking it before you need it is important. In some ways, you may get a lower valuation because you haven't accomplished as much as you think you will have sometime in the future. And in some cases, you will get a better valuation because you're not up against the wall. And how much money should you take? Sometimes it's tempting to say, I want to take enough money to forever. I want this to be the last fundraising I ever have to do. And it's a natural feeling, since raising money is not everybody's favorite thing. But the real strategy is to take money over time such that the value you get really properly reflects the risks in the investment money. So you may take money to build a prototype. You may take money then to validate that you have a product and market fit. You may then take money to establish the first scaling of that customer into widespread use. You may reach a threshold in customer acquisition effectiveness that I now know that this is the formula to get customer number 10 and customer number 20 and customer number 50. Or maybe when you go international. I'm not suggesting that by listing 5 bullets here, you should do 5 rounds of funding, but you need to figure out what is the point at which an investor looking at the company looks at the risk factors differently because of the phase that you've accomplished. And so each of these things potentially represents, at least in the abstract, a step up in valuation and a focal point and a story around investment that allows the investors to know what they are investing in. Because they're not just investing in a company, they're investing in a particular phase, because they have to ask the question of themselves, why now? Why is this the right time for my firm to take a position? Should I wait until a subsequent round where things are better validated before I jump in? There's a question of what you look for in a VC firm. And as I alluded to before, big names are good. So to some extent, you're looking at reputation, but it's often more nuanced than that. You're looking for a fit, not with a firm, but with a person, the particular lead investor. And that's who you're going to build a relationship with. And that partner becomes your advocate inside the venture capital firm. They lead your deal, they justify that deal to the rest of the firm, and they become your advisor, often your board member, and takes you through the movement through various stages. You look at whether what you're asking for, whether the stage you're at is appropriate to where what they typically want to do. There are earlier stage firms, there are late stage firms, there's firms that invest across all the different stages, and you want one that fits, so that you fit their typical round size and pace in your plan. What domain do they specialize in? If you're doing something in biotech, you may not go to a firm that focuses on AI technologies. If you're doing something in semiconductors, there's really a finite list of VC firms that pay close attention to that space. And so you want to look at what domains they focus in. And if they focus in a domain, they have a good network in that domain. You want to focus, I think, on what's the reputation of and integrity. Ask founders that they back. Look for how clearly they talk about what they've done. Are they realistic? Do they seem fair? Are they known? I mean, there's a lot of money in the world, and some of it is got goals that may be quite different from yours. And do they have a shared understanding about both what's important in general in startup and what are the key transitions in the marketplace that they also believe are taking place? Because you want investors who buy your specific definition of the mission and focus, not just that you have good numbers. And do you really fit their investment thesis? Do they fit your investment thesis? Does the theory work? Is it shared? Is it a common belief in what is going to happen next? Those are important because there's going to be a lot of arguments if you are fundamentally certain the world is going one way and they are fundamentally certain the world is going the other way. They could put a lot of pressure on you to comply with the direction that they believe in because they have leverage. Let's talk a little bit now more about mechanics. A SAFE is so common for early stage deals. It's worth understanding it a little bit.
Sorry, Chris, can I interrupt you for a quick question?
Yeah, sure.
Before we start this new argument?
Yeah.
So I know very well, or I think we all do now, of your success stories and how you raised money and now also with your family and everything. But do you have any failure stories for us? Mistakes that you made and that you recommend that we don't make? Some negative advice like don't do this, don't do that. What should we be watching for? What are things that we should not do when trying to raise money?
Oh.
I mean, it's probably the one minus what you said here, right? It's a compliment, but not necessarily. I was wondering if there is anything.
Yeah, I'm trying to think.
I can share one of mine. If you want, I can share
Okay.
one of mine real quick, right? So I started this university project with a supercomputer. We had already built silicon, and I wanted to do the next generation silicon hardware and software, and everything was going to be my startup. And I made the huge mistake of, in a way, refusing to make intermediate steps in FPGAs to prove the new architecture, because I thought, okay, we already have silicon, we'll just go for the next silicon. Right, and so that would require, as several millions of dollars that people were not so eager to give to this young startup of inexperienced people, even though everybody loved the technology. So my advice is go stepwise. Don't try to jump too far ahead of yourself. Do you have any advice similar to this, or some mistakes that you made?
Yeah. Well, certainly, if I think about Babel Labs, we actually were looking for venture money for a pretty long time. And I think that we probably started a little bit early. We didn't have a compelling story to tell about what customer problem we were really solving. We had a whole portfolio of problems that could be solved with noise removal. And we were still doing lots and lots of experiments as to what the specific customer problem was that we were going to solve. I mean, we were pursuing consumer app, we were pursuing possible design wins with smartphone companies. We only sort of stumbled into the conferencing market very well. So we were really searching around a lot, I would say, for a specific customer problem to solve, which meant we were pretty dilute in solving that. And we raised money. We started raising money well before we had an understanding of it. And it took longer. We got good money ultimately from Intel Capital and Dell Capital, but Intel and Dell are not, Andreessen Horowitz and Sequoia. And when I did talk to those firms, it was good that I had an in, but I didn't do anything that seemed to impress them. And in particular, I did not yet have a story about this is going to be huge that they needed to hear. So I think both the fact that we were early stage and the fact that we were not ambitious. We were not saying, no, this is $100 billion market that we are going to be the first mover in. It sort of locked us out of the true classic tier one.
Hi, Chris. May I also ask a question?
Yeah, go ahead. We're going to have to move along pretty quickly here. So
yeah,
make it a quick one.
It's a quick question. By the way, I'm Gabriel Andrea's friend. So I'm currently fundraising right now for an AI company I co-founded. And in the past few weeks, I met plenty between general partners and partners in various firms. And of course, many of these firms I wasn't aware of before. So how would you gauge the reputation of a VC firm among others VC in general? Like what kind of signal are you looking in a VC firm where you're trying to understand how well they're reputed? Of course, we all know about Sequoia and Andreessen Horowitz, but there are also cases in between where a firm could be good enough.
Yeah. Well, I think it's relatively straightforward. I mean, there's lots of public information and Crunchbase and others on how much they invest, how many deals do they do. So they're kind of the league tables of how much they invest. And you can easily figure out what do they invest in. And you can call up the CEOs of their recent investments and ask them, what did you like about these people? So that information about who's investing in whom is fairly visible, and I think it's just making some phone calls to do it. I mean, you may have to start with the LinkedIn, but CEOs are pretty accessible on the question of VCs, particularly if you don't ask them hard questions like, who did you reject, or what do you dislike about this VC firm? CEOs always assume that whatever they say is on the record.
Yeah.
So
I guess there's a lot of reading between the lines when it comes to figure out the negatives.
Yeah. Let me talk quickly about a SAFE. So this is not strictly speaking a loan, in that you don't pay interest and you don't have an overt repayment date. It's really simple. It's a 2-page document, and it really kicks the valuation discussion down the road. There are a number of variables there that protect investors, because they want to know that they're getting a discount, a deal on that future valuing of the money that they've put in. So the major variables are, well, how much is a given investor putting in? Is there a valuation cap? Which means, okay, I'm putting money in here, and there's going to be a valuation down the road that's based on that next round. If the future valuation is $50 million valuation on the company, this early stage investor might say, I don't want to end up paying $50 million valuation for this share. So let's put a cap on it. Say it'll be the future valuation, but never more than $25 million. Or they may say, I want a percentage discount. That is, if the valuation is $50 million, which implies a certain share price, I want a discount to compensate me for the fact that I may have invested a year or two before that price was set. There is possibly a discussion about the conversion trigger event, meaning at what point does this money put in become shares of stock? It's typically at the next priced financing round above a certain threshold, or at a liquidity event like an acquisition or an IPO. And finally, there's the question of pre-money versus post-money SAFE. And this is an important nuance to understand. When you go and raise money and sign a SAFE with one person, they know what's going to happen. But what happens if you go and then do another SAFE and another SAFE and another SAFE over time, such that investors are coming in later, conceivably after various risks have been eliminated? And it would be nice from the company's standpoint if they all shared equally, in the sense that the investors suffered the dilution that came from having all those rounds, and so that the conversion dilution that each investors get was as if they each did it individually. Whereas from an investor standpoint, the earliest SAFE investors want to know that the dilution that is coming from the subsequent SAFEs is not hurting their valuation or percentage ownership, so that the difference between a pre-money and a post-money SAFE reflects that that difference in valuing in favor of the founders or in favor of the investors. So look at that. Where did my clicker go? Where did my cursor go? There we go.